All right. Good morning, everybody. Welcome to our first Facebook Live. Hope everybody's doing well today and enjoying the beautiful weather that we've got outside. You may remember we sent out a video. I sent out a video last week in light of everything going on in the market, just to say, hey, we know that there's concern out there. So you guys reach back out to us, give us what your top questions or concerns are, so that we can, rather than us talking and doing our normal monthly update, we wanted to hear from you so that you know that we're hearing you, and so that we could, kind of answer specific questions that you guys have. So thank you for your participation. We got quite a few responses back. So again, thank you for that participation. So we've tried to, we realized we couldn't answer every single question that came in. We tried to kind of consolidate the questions that came into the top 4 categories, I guess I would say, or top 4 questions that kind of covered a number of common questions. So hopefully you'll find that your specific question was answered today. If not, feel free to reach out to us via email or phone call after you've watched this video, and we'll see if we can answer your specific question more precisely. With having said that, I'm going to toss it to Matt real quick here for a quick required disclosure.
Yeah, just wanted to make sure we mentioned the fact that, today we'll talk, like David said, about 4 or 5 different topics, but make sure you don't take anything that we say as specific advice, individualized advice. Today we're talking about a lot of macro stuff, a couple strategy specific things. So it's obviously very conversational. So just don't take anything that we say as specific advice. Go out and do it. If you want more detailed or kind of the data behind some of the things that we talk about today, obviously feel free to reach out to us. We can provide that for anybody. But just wanted to mention that before we jumped into today. And so I'm going to try to keep this to about 20 minutes. So we're going to cram as much as we can in here. So just to jump straight into it, David, one of the, not unexpectedly, but one of the most obvious common questions we got was, when do we expect this market to turn around? So if you want to jump into that.
Yeah, and I'll answer that by saying that I've had this question come up on almost every review the last 3 months. And Matt, I'm sure you can identify that. You're seeing the same thing from our clients.
Yeah.
And the obvious true answer is nobody knows for sure. But here, let me give you what I believe are the criteria that would cause the market to turn around. Number one, we've got an inflation problem right now. Everybody knows that. And the problem with inflation, the basic problem that we have right now that's causing inflation, let's put it that way, is that there's a mismatch in supply versus demand. It goes back to basic economics. When you've got the demand for everything, whether it's food or services or gasoline, for example, when demand is up here and supply is constricted for whatever reason. Right now, the reason why supply has been constricted is because we had a COVID shutdown, right, for 2 years. And so you had demand kind of artificially kept low for a long time. And then the handcuffs come off. We let everybody go back to life as normal, quote unquote. And so naturally demand for travel and everything else goes through the roof. That, along with some of the stuff going on in Russia, but primarily it's just a mismatch of supply versus demand. And so until you get the inflation problem solved, I don't think we're going to see the market really start to take off again. So how do we bring demand down? Well, consumer spending would have to go down. So in other words, unfortunately, what that may mean is prices have to get even a little bit higher before we start to see consumers actually begin to change their behavior and start to spend less, whether it be gasoline or any other item. Some good things, some good signs though that are on the horizon, and Matt, feel free to jump in here anytime you want, but some good signs that we see on the horizon is we're already starting to see an impact on the Fed's interest rate policy as it relates to housing, right? We're starting to see housing slow down significantly. That is a major element of consumer spending. And so that's a positive sign that maybe the Fed is starting to get caught up to this problem right now.
Yeah, absolutely. And I think another part of it, so I've been saying for a while, the two items that the market cares about the most, in my opinion, and they're more out there, but is inflation and rates. And we've been on historically low level of rates for a very long time, right? And so naturally asset prices typically get typically go up in a big way during that time. Just when you look at basic valuation metrics and models, low rates typically lead to higher asset prices. When I say asset prices, that means your house, your stocks, your, just general assets as a whole. And so you've seen that kind of across the board in various asset classes. And now we're entering into what will probably be at least a few years of higher rates. Now, when I say higher rates, they're just that may just mean getting back to like historical norms, but higher than what we've seen the last decade. And naturally from a fundamental valuation perspective, like that's going to put a little pressure on asset valuations. Like you said, David, you've seen it in the housing market here recently. You've seen it with stocks. You'll see it with stocks. Like investors have to take that into consideration when they're buying assets, if there's a higher risk-free rate or if the discount rate changed and some of these factors. So I think nothing overly surprising from that standpoint. The question ultimately is, right, how bad does inflation get and how long does it last and how high do rates get? And those are the two unknowns.
Yeah, and it's really unknown, but that's part of what I was trying to get to by talking about housing, right? We're starting to see demand for housing go down. We're also starting to see car lot inventory. If you've been car shopping in the last year or so, the inventories have been really low, right? Well, that problem is also starting to get fixed. We're starting to see more inventory at car lots. Retailers like Walmart, obviously right back here in our backyard, we know that they've got some, or are forecasting some inventory problems, meaning too much inventory coming up in the fall. Unfortunately, it's not going to help in the grocery area, but just inventory on other product lines. They're forecasting a glut of inventory. All those things are going to tend to put downward prices on things, right? If you've got, if supply is down here and demand is up here, the way you balance that supply demand curve is by prices going up. That's why you saw housing go through the roof, gasoline going through the roof, everything else. Well, now if you once demand comes down, and especially if demand kind of overshoots supply, in other words, demand goes down faster goes down, then you're going to overshoot it, meaning you're going to it's going to cause and that is the fundamental determinant of when the bleeding will stop or when the market will stop declining. Once there's enough upward price pressure, let's call it inflation pressure, once the inflation pressure has subsided due to declining inventories or whatever, that's going to then allow the Fed some room to let off the gas pedal in terms of their interest rate policies, right? They're going to be able to start to actually stop increasing rates or even potentially be able to cut them back a little bit to fight off deflation. So that to me is the number one thing that I'm looking for. Is the supply versus demand starting to kind of level out. And again, we're starting to see that in housing and in car lots and other inventories.
Yeah. And if you just historically look at recessions, like if you believe we're going into a technical recession, textbook definition, 2 consecutive quarters of declining negative GDP, historically, the market trades 6 to 9 months ahead of that, right? So if you feel like economically, inflation, rates, like all of that's going to get to a low, kind of the worst point, a year from now, the market just on historically looking is going to be 6 to 9 months ahead of that. So going back to the original question of when do we think the market's going to turn around? Well, just based on history, if you feel like you have a good idea of when the economy as a whole is going to start, turning around, or from an inflationary, rate perspective, the market's probably going to be 6 to 9 months ahead of that, right? And so we may already be there, right? The market could be at a bottom. The market could be bouncing because maybe we're 6 to 9 months from some of these things come to fruition, or maybe we've got another quarter or two. I don't, but as we all know,
it's impossible to know until hindsight, right?
Yeah, I mean, you don't know in your recession until you've been in it for 2 quarters.
That's right. That's right.
You're living it until. So anyways, I think we've already mentioned a lot of it and talking about a lot of it, but the next questions rolling straight in that we got a whole lot of questions about was inflation and how are we going to manage and what do we do? How do we invest in a higher inflationary period? The highest inflation we've seen in 40 years.
Yeah, so definitely normal fear or concern, maybe is a better word to use, of a lot of our clients, especially since most of our clients, most of you all are in or very near retirement. So inflation is naturally a concern, especially given what Matt just said, that we haven't seen inflation like this in, yeah, about 40 years, right? Since the late 70s, something like that. So yeah, it's been a long time. So number one, um, I would say, you want to spend less. Number one, that's ultimately the only thing that all of us, not just you, all of us can control, is our spending. So try to, if you haven't done it lately with us or just on your own, make sure you take a good hard look at your budget and figure out if there's anything that you can eliminate from your budget in terms of spending. But that's one thing that you can control, that will help you somewhat in inflationary times. Number two, to the extent possible, try to eliminate as much debt as possible. Certainly credit card debt, by all means, avoid credit card debt like the plague, but even other forms of debt, car debt, etc. If you haven't, if you do have any debt, we highly recommend the Dave Ramsey debt snowball method. We actually have courses on this for free online. We call it Money School. It's on our YouTube channel, so you can look up Money School and learn about the debt snowball. But spending less and eliminating / managing debt are going to be two of the things that are actually within your control to manage, to help you during inflationary times. Matt, what else would you have to say about that?
Yeah. Well, I would come at it from an angle of just talking through kind of the history on inflation, right? I mean, I'm a big believer that things will typically revert back to the mean. And we look at the 100 plus year average on inflation, it's 3.25%, right? And the last 10 years, it's been barely just a hair over 2%. So it's been painful because we haven't seen it in a long time. And I think it's been exacerbated by COVID and some of the supply chain issues, and it's hit us a lot harder and quicker than you would hope it would. But at the same time, I think we kind of had it coming in a lot of ways, because inflation has been so low for so long that if you're just a believer that things will inevitably revert back to the mean, that we're due for at least short-term higher points of inflation, and we almost have to have it to get us back to the mean. And right.
Yeah.
And so you look back at, as painful as it seems, we're only 6, 9, 12 months into this inflation.
Yeah.
Depending on kind of where we're at what could be the very beginning of higher inflation than what we've seen. I'm not saying it's going to stay at 8, 9, 10%, but it could stay at 4, 5, 6%, which would still be a lot higher than it had been. You go back to the 70s. I mean, from 70 to, I was looking at a chart here, from 73 to 81, the lowest inflation was 4.9. And I mean, it was 8.7, 12.3, 6.9, 4.9, 6.7, 9, 13, 12, 9. I mean, that was an entire decade of higher inflation. So some people may hear that and be like, well, thanks, Matt, that's encouraging. But I don't mean that like that's what we're going to see again, but it's just like we've been through higher inflationary periods before. We're 9 months into this. Yes, it's painful. Yes, it takes adjustments of, hey, we need to spend a little bit less here where we're, had some maybe discretionary spend where we'd kind of gotten lax on this because of low rates and because of healthy markets and so now it's just a time to go back and reevaluate and say, hey, if things do go back to the mean and over the next 10 years, we average a 3 or 4% inflation instead of a 1.5 or 2, what does that look like, right? And so I know when we're building someone's financial plan, we've always used like the historical rate of return we have, or the historical inflation rate, the long-term average, not just the last decade. And so your plan that we've helped you build takes into account us reverting back to the mean.
That's right.
So we can withstand some higher points of inflation, even if it's kind of painful, in the day to day.
Great points all around. Definitely, fully want you guys to understand what Matt is talking about reverting to the mean, because reverting to the mean applies not just to your return, but also to inflation, as he was just talking about. For those of you who were able to join us at the Top Gun movie the last few weeks, I even quoted, what was the 10-year rate of inflation back in 1980, whatever, when Top Gun came out. versus the 10-year rate of inflation today. The 10-year rate of inflation today is only like 2 point something. I don't have those figures
Yeah,
immediately.
it's like low twos.
Yeah, it was in the low twos. Whereas back then it was, I want to say it was like 6,
Yeah,
if I remember my note card correctly. So we're just reverting to the mean in terms of kind of a historically normal inflation rate. But we're also reverting to the mean in terms of historically normal rates of return. Just like Matt correctly stated, we usually typically look at it when we put our retirement analysis plans together. Most of you have done one of those with us, usually predicated on about a 3.2% average rate of inflation. We've been running significantly less than that for pretty much everybody's time with us as a client. So we're starting to revert back to that mean that we had always planned for. But we also typically plan for between a 5 to 8% rate of return for most clients, depending on your age and how conservative or aggressive you want it to be. So even with this big drop that we've seen the last 6 months, we've just kind of reverted back to what we had expected to average as far as rates of return. So if you look at your average annualized rate of return, and I know this because we've been doing lots of reviews, Matt, you can back me up on this, but we're just basically seeing client average annual rates of return revert back to what we had planned for originally, whereas we were running well ahead of that up until 6 months ago, right?
right. Yeah, no, absolutely. So theme there is reverting back to the mean can be kind of painful at times, but it's also should be expected.
Yeah.
Just as it should be expected, as if we see some years of higher inflation, we'll yet again revert back to the mean, and it will self-correct, and we'll things will come back down, right? And so so on that note, to kind of keep moving along here, we'll keep this question probably a little shorter. We had a few questions on this, but just how to benefit from a market downturn. Like, how do we take advantage of that? Any ideas there, David? Or
Yeah, the obvious number one answer on how to benefit from a down market is to buy, right? If you've got cash sitting on the sidelines, or if you've got an asset that has appreciated in value a lot, like a house or a rent house, and you sell that, you can basically move from an asset that has appreciated a lot in value to an asset class that has depreciated in value the last 6 months, i.e. moving into stock type assets. So the number one way to benefit in a down market is to buy. Warren Buffett has a famous quote that says, be greedy when others are fearful and fearful when others are greedy. So there's a pretty decent level, what I would call a healthy level of fear in the market right now. It's not what Buffett would call blood in the streets right now, but it's what I would call a healthy level of fear or concern in the market right now. So even though we don't know if this is whether we're at the market bottom right now, that's like we said earlier, you can only tell that in hindsight. The only thing you do know is it's about a 25 to 30% better time to buy now than it was 6 months ago. So yeah, that's the number one way to benefit in a down market, is if you've got cash to deploy it back into the market while it's depressed.
Yeah, I think that's the most obvious answer. And there's a lot of different kind of specific strategy details we can get into there, but for the sake of time, we won't delve into that too much today. And then last question we wanted to touch on, that was kind of a consistent question that we've gotten personally. We got through the video you posted last week, but should we move to cash? Should I go to cash? Should I not? Right? I mean, how many times have you heard that over the last week?
Yeah, we've gotten that a lot. Should we go to cash? The resounding answer is no. And the reason is because, and you probably heard this before, especially if you've heard us talk for a time, you cannot time the market. It is impossible, not difficult. It is impossible to time the market, because you got to get that call right every time. In other words, you got to know when's the right time to get out, when's the right time to get back in, when's the right time to get back out, when's the right time to get back in. And inevitably, you'll end up kind of playing this psychological game with yourself. You get out, and then the market starts to finally go up. In fact, bull markets usually start when everything looks horrible, as when there's blood in the streets, is how Buffett, I think, puts it. Right. So the right time to invest is when it feels the worst. And so inevitably, if you make that call to go to cash, you're going to be sitting on the sidelines for a long time, not believing that the market has really started to hit bottom and turn around. So we definitely discourage that. Now, have we and I think some of where this question comes from and some where the confusion comes from within our client base is we've had strategies in the past. We still have some where we have strategically made a decision to go to cash, but that has always only been with respect to the high probability option strategy. That is the only strategy that we've ever said, hey, this is probably not a good time to be in high post. Let's move to the sideline and go to cash. We have very few clients that are still in high probability options. And for those who are, they've even had signed disclosures saying, hey, I realize that I could lose, 50 or 100% of this on a bad trade. And so we don't advocate going to cash because, and I know Matt, you've got some data points to share here, but yeah, you'd be surprised at how just missing out on the first few days of the turn from bear to bull can make a big different long-term difference in your rate of return.
Yeah. So this chart here that we're going to throw up is it's a chart from Putnam Investments. So they put this together, and it just shows you it's I like it because it's actually pretty relevant from a date standpoint. It goes from end of 2006 to the end of 2021. So it's only about 6 months old here. So it shows a 15-year period, and it shows that if you missed over that time period, if you were fully invested in the S&P 500, you earned 10.66% annualized. If you missed the 10 best days, right? And remember, this is the 10 best days out of 15 years, right? So you're talking about 15 years worth of trading. You missed the 10 best days. Your rate of return drops from 10.66 to 5.05. So it's literally less than half of your annualized rate of return because you missed the 10 best days over that 15-year period. And so it just goes to show, to reiterate the point, and it goes on, you can see, everybody can see here who's watching, to miss the 20 best days. It went from 10.66 to 1.59. So over a 15-year period, you went from during an inflationary period that was, say inflation was running at 2%. If you were fully invested, stayed invested, you averaged over 10%. If you didn't, and you missed the 20 best days, you didn't even keep up with the 2% inflation, right? And so it goes to show, I know the human nature, trust me, I mean, me and David are human as well, right? So fear wants to sneak in and as just as often as it does for our clients, but we have to be, train ourselves to know how to handle those situations. And it can feel like the right decision to say, hey, we just need to bow out. We just need to get out. But there's nothing that shows from an investment strategy standpoint, from a historical perspective, historical context, that is ever the right decision if you have the right plan in place, right? Now, if you were way over invested and you were leveraged and you were doing crazy stuff to begin with, well, then, yeah, you might need to hit reset and think about a few things. But if you had a financial plan, which our clients do, if you have a financial plan and things in place and you've got cash, you've got some annuities, you've got market money invested in the market, then no, you don't need to worry about, should I go to cash, should I not, because your plan's in place, it's there. We're looking at this stuff daily, right? I mean, this is our job. And so if there's ever anything you need to do, we'll be doing it for you or reaching out and recommending it. But
the strategies do some of that adjusting automatically too, right, Matt?
100%. Yeah, exactly. I mean, in our hedged equity strategies and the strategies that we utilize are actively managed, and so the positions are being traded, the hedges are being rolled. Like, it's not just hey, let's set it and forget it, right? And right. We're constantly looking at things that we need to tweak and adjust, even if you're just in some ETF strategies. I mean, it's not hey, we'll look at this in 10 years and see how we did. So, anyways, valid question and natural concern. I don't mean to belittle that question because I know it's just human nature to want to kind of flock to safety, and cash in times like this can feel like the safest thing there is. But just stay the course, make sure you have the right plan. If you need to review your plan, obviously let us know. But stay the course. I guess that's the best piece of advice I can give.
Absolutely. And I'll reiterate something we said earlier today. If we didn't answer your specific question, we chose these 4 questions because we felt like they kind of pretty well covered 90% of all the questions that were asked in one way or another. Right. So if you feel like we didn't answer your specific question, please email us. or call us, and we'll be happy to talk to you one-on-one to answer your specific question. But thank you for taking time out of your day today. Hope this was helpful. I want you to know that we are confident, hopefully, for whatever that's worth to you. We're confident in our own strategies. We've got our own money invested in the strategies that we recommend to you. So we know we're right there along with you, and we're confident in the strategies that we're recommending. I want to close with a very important message. The Hogs are playing this afternoon in the College World Series, so go Hogs.
Go Hogs.
Okay. Anything else you want to wrap up with, Matt?
No.
Okay. Well, thank you guys again for joining us, and we look forward to seeing you soon in our office or on a Zoom call at your next review appointment. God bless you.
Thanks, guys.